Welcome to Edo Analytics, the leading platform for providing volatility data and option analytics. This is Chapter 9 of Option Trading Tutorial Series. We will cover straddle and strangle in this chapter. Straddle is an option combo formed by buying a call option and a put option with the same strike. Normally the strike is the at-the-money strike. Straddle is a strategy to express views on volatility of underlying asset. This is because when volatility goes up, straddle price will go up. This is the payoff diagram of at-the-money straddle. Below 100% strike, its payoff is exactly like a put option, while above 100% strike, the payoff is exactly like a call option. From payoff diagram, we can see that straddle buyer has positive payoff when underlying move either higher or lower. This is why we say straddle is not a directional trade, but more a volatility trade. Just like buying call or put, straddle buyers pay premium to enter into the trade. Effectively, straddle buyers pay daily theta to bet on outsized move during the tenor of straddle. Outsized move could be underlying moving either up or down. The advantage is that straddle buyers only have positive payoff at maturity. The disadvantage is that straddle buyers could lost all the premium paid. It sounds attractive that straddles have positive payoff when underlying either goes up or goes down, but straddle is normally very expensive because traders are buying call and put at the same time. On the other hand, straddle sellers receive daily theta to underwrite the upside potential gain to straddle buyers. The advantage is that straddle sellers receive daily theta. The disadvantage is that the maximum loss could be multiple times of straddle premium when underlying moving up or down drastically. It is very important to look at implied volatility when trading straddle. For example, implied volatility of 20% means market is expecting a 1% average daily move throughout the straddle tenor. The quick math is that implied volatility divided by 20 translates to a one-day straddle price. The idea is that if underlying asset moves up or down more than the implied move, straddle price will likely to go up, as gain in option value is more than the time decay. And if the underlying moves up or down less than the implied moves, straddle price will go down due to theta decay. The game plan for straddle buyers is similar to long call and long put. Straddle buyers can choose to unwind the straddle when there is an outsized move in the market. Because straddle price will go up after some outsized moves, buyers' clocks start to tick once entered into the transaction. It is important to unwind early when situation is favorable to straddle buyers. Otherwise, straddle buyers can also choose to sit with the straddle until maturity. Buyers will make money if spot at maturity deviates from strike price by the amount bigger than initial straddle premium. The game plan for straddle sellers is simply to sit with the straddle until the maturity. If spot at maturity deviates from strike price by less than the premium received at inception, then straddle sellers will make a profit. Straddle sellers can also consider unwinding early when underlying doesn't move for quite a while, which straddle sellers already pocket a large portion of straddle premium through daily theta decay. Here's an example. Assume a trader buys in 1 month, $100 straddle on an Apple with premium $4. Apple is at $100 now. In 5 days, if Apple goes up to $105, then straddle premium could go up to $6. Trader can choose to unwind the straddle and pocket the $2 profit. If trader chooses to sit with the straddle until maturity and Apple goes up to $120 after 1 month, then the payoff of straddle will be the deviation of Apple spot versus the strike, which is $20. The profit will then be $20 payoff minus $4 premium, which is $16. The next strategy is strangle. Strangle is formed by buying a call and a put, but with different strikes. Call strike is higher than put strike. Normally, people buy out of money call and out of money put. Similar to straddle, strangle is a strategy to express view on underlying volatility. This is because strangle price goes up when underlying volatility goes up. This is the payoff diagram of a 60%, 140% strangle, which is buying 60% put and 140% call at the same time. Payoff is positive and increasing when underlying spot at maturity is below 60% put strike or above 140% call strike. Between 60% and 140%, the payoff is zero. In simple words, strangle buyer is betting the underlying to move either lower than put strike or above call strike at maturity. Strangle is considered as a cheaper version of straddle. Out of money call and put are both cheaper than at the money call and put. Therefore, strangle premium is smaller than straddle. Similar to straddle, strangle buyers pay daily theta to bet on outsized move during strangle tenor, and strangle seller receive daily theta when underlying spot doesn't move. At maturity, payoff of strangle is positive when underlying spot is below put strike or above call strike. Otherwise, payoff will be zero. As summary, straddle is an expensive way to bet on underlying volatility by buying call and put with same strikes. Strangle is a cheaper version of straddle with buying out of money call and put. Both strategy is to bet on outsized move of underlying during options tenor. The key for trading is that options buyers better unwind the option once outsized moves occur with options premium goes up, while options sellers need to assess the implied volatility being priced and if it is worthy to go short volatility. This is the end of Chapter 9. Subscribe, and visit Ito Analytics website for more option-related materials.